Before we dive in, please remember that the information in this video is for educational purposes only and does not constitute financial or legal advice. I am not a licensed insurance agent or financial advisor. Always consult with a qualified professional before making any decisions about your insurance coverage. 43%. Almost half of all American drivers are overpaying for their car insurance. We're not talking about a few bucks here and there. The average overpayment is over $400 a year. Let that sink in. That's a new set of tires. It's a weekend trip you didn't take. It's a payment on your credit card or student loan that could have been made, but instead, it just vanished into the pocket of a multi-billion-dollar corporation. Why? Because of a single piece of paper or maybe a single email that most of us glance at and then file away, the auto insurance renewal. Let me be crystal clear. That renewal notice that shows up every 6 or 12 months is not a friendly reminder. It's a test. It's a test of your attention, a test of your knowledge, and a test of your willingness to accept the status quo. And right now, millions of us are failing that test, and it's costing us a fortune. Insurance companies have a name for this. They call it price optimization. It's a fancy term for a simple, brutal strategy. They slowly, almost imperceptibly, raise the rates on their most loyal customers year after year. They are betting that you're too busy, too confused by the jargon, or too complacent to notice. They're betting that you'll see the new higher price, shrug, and just pay it. It's often called the loyalty tax, and it's one of the biggest, most legal scams in the modern economy. Well, today that ends. In this presentation, I am going to give you the playbook. This is your battle plan for that renewal notice. We are going to demystify every line item, decode every confusing term, and turn that document from a source of anxiety into a tool for empowerment. By the time we're done, you will know exactly what to check, what questions to ask your agent, and how to spot the red flags that indicate you're being taken for a ride. You will not just understand your policy, you will be in control of it. You will have the confidence and the knowledge to ensure you are paying the absolute fairest price for the exact coverage you and your family need. No more and definitely no less. This has never been more critical than it is right now. You've seen it at the pump, you've seen it at the grocery store. Inflation is hitting everyone. And the auto industry is getting hammered. The cost of parts, the cost of labor to repair vehicles, the price of used cars, it's all skyrocketing. And guess who the insurance companies are passing those costs on to? The uninformed consumer. The person who just auto-renews without a second thought. They are banking on your inaction. We are going to make sure that's not you. So grab your latest renewal notice. If you don't have a paper copy, pull it up online. We are going to go through this together step by step. The very first thing you need to find, the absolute starting point of this entire process, is a section called the Declarations page. Think of this as the cover of the book, the table of contents for your entire policy. It summarizes everything, who is covered, what is covered, and how much you're paying for it. It is the single most important page in your entire insurance packet, and it's where we begin our audit. Let's break it down. At the top, you'll see the basics. Your name and address, your policy number, and the policy period or effective dates. This seems simple, but it's your first checkpoint. Are the dates correct? You need to ensure there is absolutely no gap, not even for a single day, between your old policy ending and your new one beginning. A lapse in coverage, even for 24 hours, can have catastrophic financial consequences and can cause your rates to spike in the future. Next, look for named insureds and drivers. This is a list of every person covered by this policy to drive your vehicles. Is everyone who regularly drives your cars listed here? Did your teenager just get their license? Did a child go away to college without their car? Is your spouse listed correctly? An unlisted driver who gets into an accident could, in a worst-case scenario, have their claim denied. You are paying for protection. Make sure the people you need to protect are actually on the list. Right below that, you'll find the listed vehicles. Every car covered by the policy should be here, identified by its year, make, model, and most importantly, the VIN, the vehicle identification number. Take 30 seconds, walk outside, and check the VIN on your dashboard against the VIN on this page. A single mistyped digit could mean that, technically, your car isn't the one being insured. It's a small detail that can create a massive headache during a claim. Also, check to see how the vehicle is being used. Is it listed for commute, when you now work from home and only use it for pleasure? The number of miles you drive directly impacts your premium. An outdated usage classification is just giving away free money. And then we get to the big one, the total premium. This is the number that makes you wince. the final cost for the policy term. But here's the secret. That number is a lie. Well, not a lie, but it's a distraction. It's the sum total of a dozen smaller decisions and calculations. It's the end result of the story, but we need to read the chapters. Focusing only on the final premium is like looking at the final score of a football game without knowing how any of the points were scored. To take control, you have to understand the components that build up to that final number. And those components are your coverages. This is the heart of your policy. It's a list of strange-sounding terms like bodily injury liability, property damage liability, collision, comprehensive, uninsured motorist. Beside each one, you'll see a set of numbers or a dollar amount, like 50/100/50, or a $500 deductible. These aren't just random numbers. They represent the promises your insurance company is making to you, and the limits of those promises. They dictate exactly what will be paid for if you cause an accident, or if your car is stolen, or if you're hit by someone with no insurance at all. And this right here is where the vast majority of people get it wrong. It's where the biggest savings are found. And it's also where the most dangerous financial risks are hiding. Understanding what these coverages mean, and how much you actually need, is the first real secret to mastering your auto insurance. What do those numbers, that 50/100/50, actually mean in the real world? And how do you know if you're paying for way too much coverage? Or worse, if you're one minor accident away from financial ruin because you don't have nearly enough? Let's break it down with a story. Imagine you're driving home from work. It's a Tuesday. The sun is in your eyes a little bit. You're thinking about what to make for dinner. You glance down for a split second to change the podcast you're listening to. And in that split second, the car in front of you, a brand new looking SUV, slams on its brakes. You react, but it's too late. The sound of screeching tires is followed by that sickening crunch of metal and plastic. Your airbag deploys with a violent poof, filling the car with a weird, chalky smell. You're dazed, but you seem to be okay. Shaken, but okay. You get out of the car. The driver of the SUV, a woman, is holding her wrist and crying. Her husband, in the passenger seat, is clutching his neck. Your car is a mess. Theirs is even worse. The entire back end is crumpled like a soda can. This single moment, this one bad Tuesday, is where those numbers on your insurance policy suddenly become the most important numbers in your entire life. Let's say your policy is that 50/100/50 we mentioned. This is your liability coverage. The key word here is liability. It means you are legally responsible. This coverage isn't for you. It's not for your car. It's for the damage you just did to other people and their property. It's the coverage that protects your assets, your savings, your home, your future income, from being taken away in a lawsuit. So let's look at that first number, 50. This stands for $50,000. This is your bodily injury liability limit per person. The woman driving the SUV you hit goes to the hospital. It turns out her wrist is broken in 2 places and requires surgery, pins, and months of physical therapy. The final medical bill comes to $65,000. Your insurance policy looks at that bill and says, okay, our maximum payout for any single person's injuries is $50,000. So they write a check for $50,000. But what about the other $15,000? Who pays that? You do. That $15,000 is now your personal debt. The other driver's insurance company will pay it, and then their lawyers will come after you personally to get it back. They can garnish your wages. They can put a lien on your house. They can seize your assets, all because your coverage had a $50,000 limit, and the bill was $65,000. Now let's look at the second number, 100. This is also for bodily injury liability, but it's the limit per accident. This is the absolute maximum your policy will pay for medical bills for everyone you injure in a single crash combined. Remember her husband in the passenger seat? Let's say he has severe whiplash and a concussion. His medical bills total $40,000. So we have the wife's $65,000 bill and the husband's $40,000 bill. The grand total for injuries is $105,000. Your policy is 50/100/50. The insurance company looks at the wife's bill. They pay out $50,000, the maximum for one person. They look at the husband's bill. It's $40,000, which is under the $50,000 per person limit, so that seems fine. They add the 2 payouts together. $50,000 for her, plus $40,000 for him, equals $90,000. That $90,000 is less than your $100,000 per accident limit. So the insurance company will pay the full $90,000. You are still on the hook for that extra $15,000 from the wife's bill that went over the per-person limit. But what if the husband's injuries had been worse? What if his bill was also $65,000? In that case, your insurance would pay $50,000 for her, and $50,000 for him, hitting both of their per-person limits. The total payout would be $100,000, hitting your per-accident limit. The total medical bills would be $130,000. The amount you would now personally owe? $30,000. Do you see how quickly this escalates? One accident with 2 moderate injuries, and you're facing a debt the size of a new car. Now for the third number that lasts 50. This is your property damage liability. It's the maximum your policy will pay for any property you destroy. In our story, that's primarily the brand new SUV you rear-ended. The body shop takes one look at the crumpled frame and declares it a total loss. The insurance adjuster determines the actual cash value of that SUV, just before you hit it, was $60,000. Your policy has a $50,000 limit for property damage. So your insurance company writes a check for $50,000. The remaining $10,000 to replace their vehicle? That's on you. Again. But it doesn't stop there. Did the accident happen on a residential street? Maybe you swerved and also took out a fancy brick mailbox and a prize-winning rose bush. That's property damage. Did it happen on a highway? Maybe you knocked over a guardrail or a road sign. Guess what? You get a bill for that from the State Department of Transportation. That $50,000 limit has to cover everything you broke, not just the other car. So, in our first scenario, the $65,000 wrist injury and the $60,000 totaled SUV, you are now personally on the hook for $15,000 in medical bills and $10,000 for the vehicle. That's a $25,000 bill from a 2-second distraction. And I'll be honest with you, a 50/100/50 policy is actually considered pretty average, even decent by many people. Here's where it gets truly terrifying. Every state has a legally required minimum amount of liability insurance you must carry to drive. Many people trying to save money just tell their agent, "Give me the cheapest thing you've got that makes me legal." In a state like California, the minimum is 15/30/5. Let that sink in. $15,000 for a single person's injury. $30,000 total for all injuries. And a measly $5,000 for property damage. $5,000. Can you even buy a reliable used car for $5,000 anymore? Let alone replace a brand new SUV? If you had that state minimum policy in our accident scenario, your insurance would pay $15,000 of the wife's $65,000 medical bill. It would pay the full $5,000 toward the $60,000 SUV. After your insurance paid its tiny share, you would be facing a personal lawsuit for $50,000 in medical bills and $55,000 for the vehicle. A total of $105,000. That is not just a bill. That is financial ruin. That is bankruptcy. That's losing your house. All because you tried to save maybe $20 or $30 a month on your car insurance. So the first thing you must do when you get your renewal is look at those 3 numbers. Ask yourself, in today's world of 6-figure trucks and $100,000 hospital stays, are these numbers high enough to protect my life savings? The cost to go from a 50/100/50 policy to a 100/300/100 policy, or even a 250/500/250 policy, is often shockingly small. It might be the cost of a few fancy coffees a month. It is the single best investment you can make in your financial security. But we've spent all this time talking about the other people, the other car. Liability is about making them whole again. But what about you? What about your car, which is currently sitting on the side of the road with the crumpled hood and leaking fluid? And what if you were injured too? Who pays for your hospital bills and your lost wages? Liability insurance won't pay you a single dime for your own car, or your own injuries if you caused the accident. That's where 2 other critical coverages on your policy come into play, and misunderstanding them is one of the most common and costly mistakes drivers make. We're talking about collision and comprehensive, and what they cover, and more importantly what they don't cover, is what we need to break down next. Let's start with collision. The name is pretty straightforward, but the devil is in the details. Collision coverage pays to repair or replace your car after an accident with another object. That object is usually another car, but it could also be a pole, a guardrail, a fire hydrant, or even the wall of your own garage. Yes, backing into your garage door is a collision. The key word here is your car. Collision coverage has absolutely nothing to do with the other guy's car. That's what your liability coverage is for, which we talked about before. It also has nothing to do with your medical bills. This is purely about the physical damage to your vehicle. So let's imagine you're driving on a rainy day. You're coming up to a red light, you hit the brakes but the road is slick. You slide right into the back of the SUV in front of you. It's a classic fender bender. The other driver is fine but annoyed. Your front bumper is crumpled, and one of your headlights is smashed. The estimate to fix your car comes back at $3,000. If you have collision coverage, your insurance will pay for that repair. Now here's the catch, and it's a big one: the deductible. Your deductible is the amount of money you have to pay out of pocket before your insurance company pays a single dime. It's your share of the risk. Let's say you have a $500 collision deductible. In our fender bender scenario, you would pay the first $500 of that $3,000 repair bill. Your insurance company would then cover the remaining $2,500. If you had a $1,000 deductible, you'd pay $1,000, and they'd pay $2,000. Simple math. The higher your deductible, the lower your premium will be, but we'll circle back to that critical decision in a minute. The crucial takeaway for collision is this: it covers damage to your car from an accident you caused, or even one where fault is complicated. It's your protection for your own driving mistakes, or just plain bad luck on the road. Now what about everything else? What about all the terrible things that can happen to your car when it's just sitting there, minding its own business? That is where comprehensive coverage comes in. Think of comprehensive as everything but collision coverage. It's for the stuff you have almost no control over. A nasty hailstorm rolls through and turns your car's hood into a golf ball? That's a comprehensive claim. A heavy branch snaps off a tree during a windstorm and crushes your roof? Comprehensive. You walk out to the mall parking lot to find your car is just gone? Stolen? Comprehensive. Vandalism, fire, flooding, riots, even hitting an animal like a deer is surprisingly not a collision. It's a comprehensive claim. The logic is that you can't really swerve to avoid a falling branch or a sudden hailstorm. You didn't collide with the deer collided with you. So comprehensive handles these acts of God, or non-driving related incidents. And just like collision, it has its own deductible. You might have a $500 deductible for both, or you might choose to have different amounts. For example, since things like theft or weather are less in your control, you might opt for a lower comprehensive deductible, like $250, while keeping your collision deductible higher. So when you see full coverage advertised, this is what they're talking about. It isn't an official insurance term, but it almost always means a policy that includes liability, collision, and comprehensive. It's the trio that protects other people, and then protects your own car from pretty much everything. Now for the million-dollar question you need to ask when your renewal comes up. Do you actually need collision and comprehensive? The answer isn't the same for everyone. First, the easy part. If you are leasing your car or have a loan on it, the answer is yes. You need them. In fact, your lender or leasing company almost certainly requires you to carry both coverages, often with a maximum deductible of $500 or $1,000. Why? Because until you pay it off, the bank technically owns the car. It's their asset, and they are not going to let you drive their multi-thousand-dollar asset around without full protection. If you total it, they want to be sure they get their money back. So if you have a car payment, check your renewal to make sure you have collision and comprehensive. You have no choice. But what if you own your car outright? What if you're driving a 10-year-old Honda that's been paid off for years? This is where people get into trouble. This is where you have to think like an insurance company. The decision to keep or drop these coverages hinges on one thing: the actual cash value, or ACV, of your car. ACV is not what you think your car is worth. It's not what you paid for it. It's what the car is worth today in its current condition with its current mileage right before the accident. It's the replacement cost minus depreciation. Let's say you're paying $800 a year specifically for your collision and comprehensive premiums. And let's say your 2012 sedan has an actual cash value of $4,000. You get into an accident and the car is totaled. After you pay your $500 deductible, the insurance company will write you a check for $3,500. That's it. They don't care that you just put new tires on it or that it runs great. They look at market data, and they cut a check for the ACV minus your deductible. So you have to do the math. Is paying $800 a year worth it to protect a potential $3,500 payout? For some people, yes. For others, no. A good rule of thumb many financial advisors use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, you should seriously consider dropping it. In our example, 10% of the $4,000 car is $400. Since you're paying $800 a year, you're paying way over that threshold. You're essentially paying 2 years of premiums to equal the value of the car. At this point, you might be better off self-insuring. That means dropping the coverages, taking that $800 you would have spent on premiums, and putting it into a dedicated savings account for car repairs or a down payment on your next car. The ultimate question is this: if you walked outside tomorrow and your car was gone or totaled, could you afford to repair or replace it without the insurance check? If the answer is no, I'd be in a world of hurt. Then you should probably keep the coverage. But if your car is only worth $2,000 and you have savings, paying $600 a year to protect it is probably a bad financial move. This brings us back to the deductible. Your renewal is the perfect time to review it. People often just stick with the $500 default, but this can be a huge mistake. Remember, a higher deductible means a lower premium. I once helped a friend who was paying a fortune for insurance. He had a $250 deductible. He was paying a premium for that low deductible. I asked him, "If you got in an accident today, could you write a check for $1,000 to fix your car?" He said, "Yeah, it would sting, but I could do it." We got a quote to raise his deductible from $250 to $1,000, and it saved him nearly $400 a year. He was paying an extra $400 annually just to avoid a potential $750 out-of-pocket expense. The math didn't make sense. Your deductible should be the highest amount you can comfortably afford to pay on a bad day without derailing your finances. Check your emergency fund. If you have a few $1,000s saved, a $1,000 deductible is a no-brainer. You take on a little more risk, but you get guaranteed savings on your premium year after year. So when you look at that renewal, don't just glance at the total. Find the line items for collision and comprehensive. Look at the premiums and the deductibles. Go online to a site like Kelley Blue Book and get a realistic actual cash value for your car. Then do the math. Are you overpaying to protect a low-value vehicle? Is your deductible so low that you're leaving hundreds of dollars in guaranteed savings on the table? These two coverages are the core of protecting your own property, but they do nothing to protect the most valuable thing in the car, you. What happens when you're hit by someone who has no insurance or not enough? Who pays for your medical bills if you're injured in an accident? That's where the next section of your policy becomes absolutely critical, and it's filled with confusing acronyms that could make or break your financial future after a crash. Let's dive into that alphabet soup, because this is where a simple fender bender can turn into a life-altering financial catastrophe. The first two sets of letters you need to look for are either PIP or MedPay. That's PIP, for personal injury protection, and MedPay, for medical payments coverage. Think of these as your personal health insurance for a car crash. They are your coverage for you and your passengers regardless of who is at fault. This is a concept that so many people miss. They think, well, if the other person hits me, their insurance will pay my medical bills. And they are right, eventually. But eventually can mean months, or even years, of fighting with another insurance company, while the hospital is sending you collection notices today. Your MedPay or PIP is designed to be the financial first responder. Pays your medical bills right away so you can focus on healing, not haggling. Now, what's the difference? It mostly depends on what state you live in. MedPay is pretty straightforward. It covers necessary medical and dental expenses for you and your passengers after an accident. It's a set amount, maybe $1,000, $5,000, or $10,000, and it pays out quickly. PIP, or personal injury protection, is like MedPay on steroids. It's primarily for people living in what are called no-fault states. Because it's a no-fault system, your own insurance is the primary payer for your injuries up to a certain limit, no matter who caused the crash. So, PIP not only covers your medical bills, but it often also covers other things MedPay doesn't, like lost wages if you can't work, and even the cost of hiring someone to do essential household tasks you can no longer perform, like childcare or cleaning. Let's make this real. Imagine you're in a crash that's clearly not your fault. You have a broken arm and some other injuries. Your hospital bill is $10,000. You're going to miss a month of work, which costs you another $5,000 in lost income. If you have zero MedPay or PIP, you're in a world of hurt. You have to pay that $10,000 hospital bill out of pocket, or hope your personal health insurance covers it after you meet your massive deductible. You also have to eat that $5,000 in lost wages. You're now $15,000 in the hole, waiting and praying that the other driver's insurance company will eventually agree their driver was at fault and write you a check. That is a terrifying position to be in. Now let's rewind. Same accident, but you have a $10,000 MedPay policy. As soon as you get that hospital bill, you submit it to your own insurance company and boom, they pay it. You're still out the $5,000 in lost wages, but at least the medical debt isn't hanging over your head. It's a huge relief. But let's rewind one more time. Same accident, but you live in a no-fault state and have a good PIP policy with a $25,000 limit. You submit the $10,000 hospital bill, it gets paid. You submit your pay stubs to prove your $5,000 in lost wages, that gets paid too. You haven't spent a dime out of pocket. You're not waiting on anyone. You're financially stable, and you can focus entirely on your recovery. You see the difference? It's not just a line item on a piece of paper. It's your financial safety net when you are at your most vulnerable. So on your renewal, find that line. Do you have MedPay or PIP? A lot of people waive it to save maybe $10 or $20 a month. That is one of the most dangerous financial gambles you can possibly make. Having at least $5,000 or $10,000 in this coverage is an absolute must. But this only solves the first part of the problem. It covers your immediate bills. What happens when the person who hit you has no insurance at all? Or what if they have the state minimum, and your injuries are catastrophic? This brings us to the two most criminally misunderstood and undervalued coverages on any auto policy: uninsured motorist and underinsured motorist coverage, UM and UIM. Let's start with uninsured motorist. This one is simple. You get hit by someone who has broken the law and is driving with zero insurance. Who pays for your injuries? Who pays for your pain and suffering? Who pays for your long-term care? You can't get blood from a stone. Suing an uninsured driver is usually a waste of time and money. If they couldn't afford a basic insurance policy, they certainly can't afford to pay your $100,000 medical judgment. This is where your uninsured motorist, or UM coverage swoops in to save you. It essentially steps into the shoes of the at-fault driver and pays you what their insurance should have paid you. According to the Insurance Research Council, about 1 in 8 drivers on the road in the United States is uninsured. That means every time you're at a stoplight with 8 cars around you, there is a statistical likelihood that one of them has no way to pay for the damage they might cause you. Your UM coverage is the only thing standing between you and them. Now let's talk about its evil twin, underinsured motorist or UIM. This one is even more insidious. The person who hits you has insurance. They're a responsible citizen, right? But they only have the state minimum liability. Let's say it's $25,000. But the accident they cause puts you in the hospital for weeks. Your medical bills climb to $150,000. Their insurance company will gladly write you a check for $25,000. That's the maximum their policy will pay. That's all they are legally obligated to give you. So you're left with a bill for $125,000. What do? This is the nightmare. This is where your underinsured motorist, or UIM coverage, becomes your hero. After the other driver's insurance pays their $25,000 limit, your UIM policy kicks in to cover the rest, all the way up to your own policy's limit. So how much UM and UIM coverage should you have? This is where I'm going to give you the single most important rule of thumb in this entire series. Are you ready? Your uninsured and underinsured motorist coverage limits should mirror your bodily injury liability limits. Let me say that again. Your UM/UIM limits should be the exact same as your liability limits. Think about the logic here. In the last part, we talked about setting your liability limits. Let's say you decided on 100/300. That's $100,000 per person, $300,000 per accident. You made a conscious decision that if you hurt someone, you want to have enough coverage to provide up to $100,000 for their medical care. You decided that was a responsible, ethical amount of protection to offer a stranger. So my question to you is this: why on earth would you provide less protection for yourself? Why would you provide less protection for your spouse, or for your children riding in the car with you? If you believe a stranger's well-being is worth $100,000, isn't your own? When you look at your renewal, find your bodily injury liability limits. Then find your uninsured/underinsured motorist limits. If they are not the same, you need to call your agent immediately. You are telling the world that you value a stranger's health more than your own family's. Increasing your UM/UIM limits to match your liability is often one of the least expensive changes you can make to your policy, and it provides an astronomical amount of protection. You are protecting yourself from the financial irresponsibility of millions of other drivers on the road. So we've covered the people, the liability, and the medical bills. But what about the one thing you see every day? Your actual physical car. What happens when it's a crumpled wreck on the side of the road? Or stolen from your driveway? That's when two more little words on your policy, comprehensive and collision, become the most important words you'll read. And most people get them completely wrong. Let's start with the biggest misconception right out of the gate. People think collision and comprehensive are basically the same thing. Or they think full coverage is some magical term that includes them automatically. Both are dangerously wrong. They are two completely different types of protection. They cover completely different disasters, and you have to choose them and their deductibles separately. First, let's talk about collision. The name is pretty straightforward. This coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, the wall of your own garage. If you hit something, collision coverage is what kicks in to fix your vehicle. It doesn't matter if the accident was your fault or the other driver's fault. If your car is damaged from an impact, this is your safety net. Imagine this scenario. You're at a crowded mall parking lot during the holidays. You're trying to back out of a tight spot, you're craning your neck, you check your mirrors, but you misjudge the angle of the concrete pillar right behind you. You hear that sickening crunch of metal and plastic. Your heart sinks. You get out and see your rear bumper is hanging off and the quarter panel is crushed in. A quick call to the body shop gives you the bad news. It's a $3,000 repair. If you don't have collision coverage, that $3,000 is coming straight out of your bank account. Your liability insurance, which we talked about before, does nothing for you here. That only covers the damage you do to others. But if you have collision coverage, you just have to handle your deductible. And the deductible is the second key part of this equation. Think of it as your copay. It's the amount of money you agree to pay out of pocket for a repair before the insurance company steps in. Let's say you have a $500 deductible. In our parking lot scenario, you would pay the first $500 of that repair bill, and your insurance company would pay the remaining $2,500. If you had a $1,000 deductible, you'd pay the first $1,000, and they'd pay the next $2,000. The higher your deductible, the lower your premium will be, but we'll circle back to that critical decision in a minute. The bottom line is, collision covers damage to your car from an impact, minus your deductible. So what about comprehensive? This is the one that really trips people up. The easiest way to think about comprehensive coverage is that it pays for almost every other type of physical damage to your car that isn't a collision. It's the life happens coverage. This is for the things that are generally outside of your control. Let's say a freak hailstorm rolls through town and turns the hood of your car into a golf ball. That's a comprehensive claim. A deer decides to play chicken with you on a country road at dusk and you can't avoid it. Comprehensive. You're parked under a big oak tree during a windstorm and a heavy branch snaps off, caving in your roof. Comprehensive. Vandals smash your windows, someone steals your catalytic converter. Or worst of all, you walk out in the morning and your car is just gone. Stolen. All of these are covered by comprehensive insurance. Fire, flood, riots, earthquakes. It's a long list of unfortunate events. A common point of confusion is that deer example. You hit a deer, isn't that a collision? Logically, yes. But for insurance purposes in nearly every state, hitting an animal is considered a comprehensive claim. The general thinking is that a deer running into the road is a random, unavoidable event, more like a falling object than a predictable collision with a stationary pole. This is a huge benefit, because comprehensive claims are less likely to raise your rates than at-fault collision claims. So when you look at your renewal, you'll see two separate lines. One for collision and one for comprehensive. And each will have its own deductible. Very often, people choose a lower deductible for comprehensive, maybe $250 or $500, because the things it covers, like a cracked windshield from a rock on the highway, are more common and less expensive to fix. Now for the million-dollar question you need to ask yourself when that renewal notice arrives. Do I still need both? If you have a loan or a lease on your car, the answer is not up to you. It's yes. Your lender or leasing company requires you to carry both collision and comprehensive coverage. Why? Because until you pay it off, they are a part owner of that vehicle. It's their asset on the line. They need to make sure that if the car gets totaled or stolen, there is money to pay off the loan balance. They're protecting their investment, and you agreed to it in the fine print of your loan contract. Dropping this coverage would be a violation of your loan agreement. But what if you own your car outright? The title is in your name, free and clear. Now you have a choice to make, and it's a purely financial one. This is where you have to become a cold, calculating machine and take the emotion out of it. Your decision should be based on one thing: the actual cash value or ACV of your vehicle. Actual cash value is what your car was worth the second before it was damaged. It's not what you paid for it. It's not what a brand new one costs. It's the market value of your specific year, make and model, with its specific mileage and condition. Think of it as the private party sale price on Kelley Blue Book or Edmunds. Here's the financial gut check. Find the actual cash value of your car. Then, look at your insurance renewal and find out how much you are paying per year specifically for the collision and comprehensive portions of your policy. A common financial rule of thumb is this. If your annual premium for comp and collision is more than 10% of your car's value, it may be time to consider dropping them. Let's do the math. Say you have a trusty 10-year-old sedan. Its actual cash value is about $5,000. You look at your policy and you're paying $60 a month or $720 a year for comp and collision. That's over 14% of the car's total value. You're paying a significant amount of money to protect a depreciating asset that's not worth a whole lot to begin with. In a scenario like this, you could be better off dropping the coverage, taking that $720 you save each year, and putting it into a dedicated car repair or replacement savings account. But there's an even more important, more personal test. Ask yourself this question and be brutally honest. If I walked outside tomorrow and my car was totaled, could I afford to repair it or buy another car with cash from my emergency fund without it causing a major financial catastrophe for my family? If the answer is a confident yes, then you might be a good candidate to drop these coverages on an older car. You're essentially choosing to self-insure. But if the answer is no, and the sudden loss of your car would leave you unable to get to work or force you into debt, then you absolutely need to keep the coverage, no matter how old the car is. That premium isn't just a bill. It's buying you peace of mind and financial stability. Finally, let's talk about the deductible strategy. This is the #1 lever you can pull on your renewal to directly impact your premium. Remember, higher deductible equals lower premium. If you currently have a $500 deductible for collision, ask your agent for a quote to raise it to $1,000 or even $1,500. The savings can be dramatic, often 15 to 30% off that portion of your premium. The same goes for your comprehensive deductible. But here is the golden rule, and please do not ignore this. Never ever choose a deductible you cannot easily afford to pay tomorrow in cash. It is financial malpractice to choose a $2,000 deductible just to save $25 a month if you don't have $2,000 available. That's not a clever savings strategy. That's a high-stakes gamble where you're betting you won't have an accident. And the house always wins that bet, eventually. Your deductible should match what you have saved in your emergency fund. So you've made the smart choices. You've protected your own car against collisions, theft, and acts of nature. You're covered. But what happens when your mistake doesn't just dent your own fender, but totals someone else's brand new $60,000 luxury SUV? Or worse, what if it isn't just a car you hit? We're talking about the one coverage limit on your policy that could bankrupt you in a split second. And the state minimums are a terrifying joke. We're talking about your liability coverage. This is the absolute core of your auto insurance policy. It's the part that doesn't pay you a single dime. Instead, it pays for the damage you do to other people and their property. It's the coverage that stands between you and financial ruin after a bad day on the road. And it's broken down into two key parts: bodily injury liability and property damage liability. When you look at your policy, you'll see three numbers separated by slashes. Something like 25/50/25 or 50/100/50. This isn't a secret code. It's the blueprint for your financial survival or your financial demise. Let's break it down. The first number is your bodily injury liability limit per person. If you cause an accident and injure someone, this is the maximum amount your insurance company will pay for that one person's medical bills, lost wages, and pain and suffering. The second number is your bodily injury liability limit per accident. This is the maximum total amount your policy will pay out for medical-related expenses for all people you injure in a single accident, no matter how many there are. The third number is your property damage liability limit. This is the maximum your policy will pay to repair or replace whatever property you damage, which is usually someone else's car, but it could also be a mailbox, a storefront, or a city light pole. Now let's talk about those state minimums. In many states, the legal minimum liability you can carry is something like 25/50/25. $25,000 for one person's injuries, $50,000 total for everyone's injuries in the accident, and $25,000 for property damage. Let me be crystal clear. Carrying state minimum liability is like trying to put out a house fire with a spray bottle. It is a catastrophic financial decision that gives you a completely false sense of security. You are legally insured, but you are in no way, shape, or form protected. Let's make this real. Let's invent a driver named Alex. Alex is a good person, a safe driver, has a decent job, and is saving up for a down payment on a house. To save about $20 a month, Alex has state minimum 25/50/25 liability coverage. One rainy afternoon, Alex is driving home and glances down at a text message for just 2 seconds. In those 2 seconds, the car in front, a brand new Ford F-150, slams on its brakes. Alex plows right into the back of it. It's a serious impact. The driver of the truck, a contractor named Sarah, is jolted forward. Her head hits the steering wheel. The airbags deploy. Her truck is a mess. Let's do the math. The first bill is for the ambulance to take Sarah to the emergency room. That's $2,000. The ER visit with a CT scan to check for a concussion, X-rays for her neck and back, and initial treatment adds another $8,000. That's $10,000 gone just in the first few hours. Sarah has a severe concussion and 2 herniated discs in her neck. She needs to see a neurologist and an orthopedic specialist. She'll need weeks of physical therapy. She's a contractor who relies on her physical ability to work, but she can't lift anything for at least 3 months. The initial medical bills before any major procedures have already blown past Alex's $25,000 per person limit. And we haven't even talked about surgery, which her doctor is recommending. A spinal fusion surgery can easily cost over $100,000. And what about her lost wages? Sarah makes $60,000 a year. Being out of work for 3 months means $15,000 in lost income. If she can't return to the same physical work, we could be talking about a lifetime of diminished earning capacity. The claim for her injuries alone, the medical bills, the future care, the lost income, the pain and suffering, is now climbing to $200,000. Alex's policy pays out its maximum of $25,000. And then the insurance company wishes Alex the best of luck, because now Sarah's attorney is coming after Alex personally for the remaining $175,000. But wait, we forgot about the truck. It was a brand new, fully loaded F-150. With the frame damage from the impact, it's declared a total loss. The replacement value is $70,000. Alex's property damage limit is $25,000. The policy pays that out, and now Alex is also on the hook for the remaining $45,000 to replace Sarah's truck. In the span of a 2-second distraction, Alex, who was saving for a house, is now facing a personal lawsuit for $220,000. That down payment Alex was saving? Gone. The court will order Alex's wages to be garnished, meaning a percentage of every single paycheck will go to Sarah until that debt is paid. Could take decades. A lien will be placed on any property Alex owns. Any future inheritance? Gone. Alex's financial life, for all practical purposes, is over. All to save $20 a month. This isn't a scare tactic. This is reality. These scenarios play out in courtrooms across America every single day. The cost of a single modern car, a single ambulance ride, a single surgery can financially vaporize someone with low liability limits. So what should you do? When you get your renewal, look at those 3 numbers. If they are anything less than 100/300/100, you need to call your agent immediately. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This should be your new minimum. In today's world of $70,000 pickup trucks and $1 million medical bills, even that might not be enough. The ideal, financially responsible coverage for most middle-class families is $250/500/100, $250,000 per person, $500,000 per accident, and $100,000 for property damage. You might be thinking, that must cost a fortune. You will be shocked at how little it costs to make this change. The jump from state minimum liability to truly protective 100/300/100 limits might cost you less than a couple of fancy coffees a month. The jump from there to the gold standard of $250/500/100 might be another $10 or $15 a month. It is the single greatest bargain in personal finance. For the price of a Netflix subscription, you are buying a fortress around your assets, your savings, your future earnings, and your family's financial security. You are protecting everything you have worked for, and everything you will ever work for, from one single devastating mistake on the road. If you have significant assets, a house, investments, a healthy retirement account, you should also be asking about an umbrella policy. This is a separate policy that sits on top of your auto and home insurance and provides an extra $1 million or more in liability coverage. It's the ultimate defense. So, your first and most critical action item when you get that renewal is to check your liability limits. Do not accept the state minimum. Do not be like Alex. Protect yourself. This isn't about insuring your car. It's about insuring your life. Now, we've just spent all this time talking about how to pay for damage you cause to other people. We've built a financial fortress to protect your life savings from a lawsuit. But what about your own car? What happens when it's your car that's a mangled wreck on the side of the road? Liability coverage won't pay a penny to fix or replace it. For that, you need two entirely different coverages, and understanding how they work together is the key to not being stuck with a car payment on a vehicle you can no longer drive. These two coverages are collision and comprehensive, and if you have a car loan or a lease, you almost certainly already have them because your lender demands it. But do you actually know what they do, or more importantly, when you might be paying for something you no longer need? Let's break it down because this is where people waste thousands of dollars over their lifetime. First up is collision coverage. The name is pretty straightforward. This coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. This could be a collision with another car, a telephone pole, a guardrail, your garage door, you name it. If you hit something, collision coverage is what you'll use. And here is the most important part. It pays out regardless of who is at fault. If you cause the accident, your liability coverage pays for the other person's car, and your collision coverage pays for your car. If the other person causes the accident and they have insurance, their liability coverage should pay for your car. But what if they don't have enough insurance? What if they're an uninsured driver and they flee the scene? What if the claims process is dragging on for weeks and you need your car fixed now? In all those cases, you can file a claim on your own collision coverage to get your car repaired immediately. Your insurance company will then go after the at-fault party's insurance to get their money back, a process called subrogation. But you don't have to wait for that to play out. You get your car back on the road. Now, collision coverage isn't a blank check. It comes with a deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Think of it as your share of the risk. Deductibles typically range from $250 to $2,500. With $500 and $1,000 being the most common. Let's say you have a $1,000 deductible. You swerve to avoid a squirrel, hit a curb, and do $4,000 worth of damage to your suspension and front end. You would pay the first $1,000, and your insurance company would pay the remaining $3,000. Choosing your deductible is a critical decision you make when you buy the policy, and one you should reevaluate at every renewal. It's a simple trade-off. A higher deductible means you're taking on more personal risk, so the insurance company rewards you with a lower premium. A lower deductible means the insurance company is on the hook for more money, so they charge you a higher premium. The golden rule for choosing a deductible is this. Pick the highest amount you can comfortably afford to pay at a moment's notice without causing a financial crisis. If you have a $1,000 deductible but you don't have $1,000 in your emergency fund, you've set yourself up for failure. You're essentially betting you'll never have an accident. That's a risky bet. So that's collision. Covers you when you hit something. But what about all the other ways a car can be damaged? What about theft? Vandalism? A deer jumping out in front of you? That's where the second coverage comes in. Comprehensive coverage. Some people call it comp, and in policy documents you might see it listed as other than collision coverage, which is actually a perfect description. It covers damage to your car from almost anything other than a collision. This is your protection against the random, unpredictable events of life. Think of it as the bad luck insurance. A tree branch falls on your car during a windstorm. A hailstorm leaves your hood looking like a golf ball. You hit a deer on a country road. Your car is stolen from your driveway. Someone keys your car in a parking lot. A rock flies up from the highway and cracks your windshield. All of these are classic comprehensive claims. One of the biggest points of confusion for people is the deer scenario. Hitting an animal is almost always a comprehensive claim, not a collision claim. The logic is that you couldn't reasonably avoid the collision. The animal entered your path of travel. However, if you swerve to avoid the deer and then hit a tree, that's now a collision claim because you collided with a stationary object. It's a weird distinction, but it can matter for your rates and your record. Just like collision, comprehensive coverage has a deductible. It works the exact same way. If a tree branch causes $3,000 in damage and you have a $500 comprehensive deductible, you pay $500, and the insurance company pays $2,500. You can choose to have the same deductible for both collision and comp, or you can have different amounts. For example, since comprehensive claims are often less severe, some people opt for a lower deductible on comp and a higher one on collision. Also, a quick pro tip: check your policy for glass coverage. Many companies, depending on your state, offer a $0 or a very low $100 deductible for windshield repair or replacement as part of their comprehensive coverage. So, when you hear someone say they have full coverage, this is what they're usually talking about. They have the state-required liability, plus they've added collision and comprehensive. Full coverage is not an official insurance term. It's just slang. But it means you have protection for other people's damages and protection for your own car. Now for the multi-thousand-dollar question: when do you actually need these coverages, and when are you just throwing money away? The first part is easy. If you have a loan or a lease on your vehicle, you are required to have both collision and comprehensive. No exceptions. The bank or leasing company is the legal owner of the vehicle until you pay it off, and the car is their collateral. They need to protect their investment. If you get into an accident and total the car, they need to know that an insurance company is going to pay off the value of their asset. If you try to remove these coverages while you still have a loan, the lender will find out and they will take out a policy on your behalf called force-placed insurance, and it will be astronomically expensive, far more than what you would pay on your own. So, if you have a car payment, you need collision and comp. Period. But what about when you own the car outright? This is where you can make a smart financial decision that saves you a fortune. The moment you pay off that loan, you have the freedom to drop these coverages. But should you? The decision hinges on one simple concept: your car's value versus the cost of the insurance. Remember, insurance pays the actual cash value, or ACV, of your vehicle if it's totaled. That's the market value of your car right before the crash, taking into account its age, mileage, and condition. It is not what you paid for it. It's not what it costs to buy a new one. It's what your specific used car was worth. So here's the thought process you need to go through at every single renewal. First, go to a site like Kelley Blue Book or Edmunds and get a realistic private party value for your car. Let's say your 10-year-old sedan is worth $3,000. Second, look at your policy and find your collision deductible. Let's say it's $1,000. Third, do the math. The absolute maximum insurance payout you could ever receive for this car is the actual cash value minus your deductible. In this case, $3,000 minus $1,000 equals $2,000. That's your best case scenario payout. Fourth, look at your insurance bill. Find out how much you are paying per year or per 6-month term, and then double it specifically for the collision and comprehensive portion of your premium. Your declaration page should break this down. Let's say you're paying $500 a year for both. Now you have the critical question to ask yourself: is it worth paying $500 this year to protect a maximum potential payout of $2,000? Maybe it is. But what if your car is only worth $2,000? Now your max payout is only $1,000. Is it worth paying $500 to protect a $1,000 asset? The math gets a lot less compelling. A good rule of thumb many financial experts use is the 10% rule. If the annual cost for your collision and comp coverage is more than 10% of your car's value, it might be time to consider dropping it. A better rule is the self-insurance rule. If your car were totaled tomorrow, could you afford to repair or replace it with cash from your savings without it causing a major financial hardship? If the answer is yes, then you are in a position to self-insure that risk. You can drop the coverages, bank the money you were spending on those premiums, and save it for an eventual car repair or replacement. You are accepting the risk yourself in exchange for guaranteed savings. Understanding this calculation is the key to not overpaying for insurance on an older, paid-off vehicle. But this brings up a terrifying scenario for those who do have a car loan. What happens if you total your car, and the actual cash value the insurance company gives you is less than what you still owe the bank? This is called being upside down, and it happens to millions of people. You're left with no car, and a bill for thousands of dollars to a bank for a pile of metal that no longer exists. There is a specific crucial coverage designed to prevent this exact nightmare, and it's one you absolutely need to understand. This coverage is called gap insurance, and the name is beautifully simple. It exists to cover the gap between what your car is actually worth and the higher amount you still owe on your loan or lease. It is the financial firewall that stands between you and disaster. To really understand its power, Let's walk through a scenario that happens every single day in America. Meet Sarah. Sarah just landed a great new job and decides to treat herself to a new car. A reliable, stylish SUV that costs $40,000. She's excited. She doesn't have a huge amount saved for a down payment, so she puts down $2,000 and finances the remaining $38,000 over 72 months. She drives off the lot feeling on top of the world. Her insurance policy has all the standard stuff. Liability, collision, comprehensive. She feels protected. Fast forward exactly 1 year. Sarah is driving home from work when another driver runs a red light and T-bones her SUV. The crash is severe. Thankfully, Sarah's okay, just shaken up. But her beautiful year-old SUV is a twisted wreck. The body shop and her insurance adjuster both agree. It's a total loss. Now the insurance process begins. The company looks at the market value of a 1-year-old version of her exact SUV. They check listings, auction data, and condition reports. This is called the actual cash value, or ACV. Because of first-year depreciation, that massive drop in value a new car takes the second it becomes a used car. They determine her SUV's ACV is now only $30,000. Her collision deductible is $1,000. So the insurance company prepares to write a check for $29,000. Here's where the nightmare begins. Sarah calls her lender to get the payoff amount for her loan. Over the past year, her monthly payments have mostly gone toward interest, not the principal. She discovers she still owes the bank $35,000. Let's do the math. The insurance company is paying $29,000. That entire check goes directly to the bank because the bank technically owns the car until the loan is paid off. But the loan is for $35,000. After the insurance money is applied, Sarah still owes the bank $6,000. This is the gap. $6,000. So now, Sarah is left with no car to get to her new job, and a bill from the bank for $6,000. She is legally obligated to continue making monthly payments on a vehicle that is now sitting in a scrapyard. This is the exact situation that financially cripples people. It's an anchor of debt with absolutely nothing to show for it. Now let's rewind. Let's put Sarah back at the dealership a year ago. This time when she buys her insurance, she adds gap coverage. It might add $5 or $6 a month to her premium. A tiny amount. She probably doesn't even notice it. Now fast forward again to the same accident. The car is totaled. The insurance company determines the ACV is $30,000, and after her deductible, they pay out $29,000 to the bank. The loan balance is still $35,000. There is still that $6,000 gap. But this time is different. This time her gap insurance kicks in. It is designed for this one single purpose. It writes a check for that remaining $6,000 and pays the lender directly. The loan balance is wiped out. It becomes zero. Sarah walks away clean. She has no car, but crucially, she has no debt. She is free to take a deep breath and figure out her next steps without a multi-thousand-dollar bill hanging over her head. That is the power of gap insurance. So, when you get your renewal, you need to ask yourself 2 critical questions. First, do I need gap insurance? And second, am I paying for it when I no longer need it? Let's start with who absolutely needs to consider it. If any of these apply to you, you should be making a phone call to your agent today. 1. You made a small down payment or no down payment at all. The general rule of thumb is if you put down less than 20% on a new car, you are almost guaranteed to be upside down, owing more than the car is worth, for the first few years of your loan. 2. You have a long financing term. Those 60, 72, or even 84-month loans are tempting because they lower your monthly payment. But they also mean you build equity incredibly slowly. For years, your payments are mostly interest, while your car's value is plummeting. This creates a massive and long-lasting gap. 3. You rolled negative equity from a previous car into your new loan. This is a huge red flag. It means you were already upside down on your last car, and you just piled that old debt on top of your new debt. You are starting your new loan deeply in the red, and the gap is a chasm. 4. You are leasing a vehicle. In fact, most lease agreements require you to have gap coverage. The leasing company often bundles it into your payment, but you must verify this. Never assume. And 5. You bought a vehicle that depreciates quickly. Some luxury models or certain types of cars lose value faster than others. A quick Google search for your car's make and model plus depreciation rate can be very revealing. Now, where do you get it? The dealership will offer it to you, often with high-pressure tactics, when you're signing the paperwork. This is almost always the most expensive option. They can charge anywhere from $500 to over $1,000, and they roll it right into your car loan, meaning you're paying interest on the cost of the insurance itself. It's a terrible deal. The best place to get it is almost always from your auto insurance company. On your policy, it might be called gap insurance or more commonly, loan/lease payoff coverage. It's typically a tiny fraction of the cost. We're talking a few dollars a month. It's one of the best bargains in the entire insurance world. This brings us to the second critical question for your renewal. Are you paying for it when you don't need it anymore? Gap insurance is not a set-it-and-forget-it coverage. There will come a point in your loan, usually after a few years, where your loan balance finally drops below your car's actual cash value. The gap no longer exists. At that moment, you are paying for protection you cannot possibly use. So, on your renewal, find that line item. Then do two things. First, get your current loan payoff amount from your lender. Second, go to a site like Kelley Blue Book or Edmunds and get a realistic private party value for your car. If the car is worth more than you owe, you no longer need gap insurance. A simple phone call to your agent to remove it can save you money on every future payment. Now, gap insurance is about protecting your loan. It's about getting you back to zero. But what if you don't want to be at zero? What if you just bought a brand new $40,000 car? It gets totaled a year later, and the $30,000 check from the insurance company isn't enough to go buy another brand new one. You don't want to be stuck getting a used car to replace the new one you just lost. For this, there is another related coverage you might see on your renewal. New car replacement. This is a step beyond gap insurance. If your new car is totaled within a specified time, usually the first 1 or 2 years of ownership or under a certain mileage, this coverage doesn't just pay the depreciated actual cash value. It pays to replace your totaled car with a brand new one of the same make and model. So in Sarah's example, instead of just getting a $30,000 check for her 1-year-old car's value, new car replacement coverage would give her the full $40,000 needed to go buy this year's brand new model. It completely negates that first-year depreciation hit. It costs more than gap insurance, and it's only available for new vehicles, but it provides a level of protection that ensures you aren't financially knocked backwards by a total loss. Gap insurance saves you from debt. New car replacement restores your original purchase. They are two different tools for two different jobs. We've now covered your vehicle from every angle, from fender benders to theft to total loss scenarios that could leave you in debt. We've protected the metal, the glass, and the loan. But in any accident, the most important thing inside that car isn't the engine or the stereo system. It's you and your passengers. What happens when the bills for the ambulance, the emergency room, and the physical therapy start arriving? Who pays for that? What if you can't work for weeks? The answer is far more complex than you think, and it can change dramatically depending on what state you live in. There are specific coverages designed entirely to protect your body and your bank account from medical debt, and understanding them is absolutely non-negotiable. Let's start with the two most important acronyms you've probably seen on your policy but never truly understood: MedPay and PIP. That stands for Medical Payments Coverage and Personal Injury Protection. Think of these as your personal financial medics, rushing to the scene of an accident to stop the bleeding from your bank account. They are fundamentally different from liability coverage, which pays for damage you caused to others. MedPay and PIP are for you and your passengers, regardless of who is at fault for the accident. This is a critical distinction. In the chaotic aftermath of a crash, fault can take weeks or even months to determine. While lawyers and adjusters are arguing, who's paying the ambulance bill? Who's covering the emergency room copay? You are. Unless you have one of these coverages. Let's break down medical payments or MedPay first. It's the simpler of the two. MedPay is available in most states, and it's designed to cover reasonable and necessary medical and funeral expenses for you and anyone in your car who gets injured in an accident. It's a no-fault coverage, meaning it pays out immediately without waiting for a legal battle to conclude. The limits are typically modest, often ranging from $1,000 to $10,000, maybe $25,000 on the high end. You might be thinking, $10,000? That won't even cover the first hour in the ER. And you're not wrong. But that's not its primary job. Think of MedPay as your health insurance deductible slayer. Let's say you have a fantastic health insurance plan, but it comes with a $5,000 annual deductible. You get into a car accident in February, and the initial bills are $7,000. Your health insurance won't pay a dime until you've paid that first $5,000 out of your own pocket. But if you have $5,000 in MedPay coverage, Your auto policy can pay that deductible for you. The bill is handled, your credit is protected, and you haven't spent a single cent. It acts as the perfect bridge, filling the gap that your health insurance intentionally leaves open. Another crucial reason for MedPay? Your passengers. Your amazing health insurance policy does absolutely nothing for your friends, your coworkers, or your cousin who you're driving to the airport. If they're injured in your car, they're on their own with their medical bills, at least initially. This can lead to incredibly awkward, relationship-destroying situations where they may be forced to sue you to get the at-fault driver's insurance to pay. But with MedPay, your policy can immediately step in and offer to cover their initial medical expenses up to your limit. It's a gesture of goodwill and a financial shield that protects the people you care about when they're in your care. For the incredibly low cost of this coverage, often just a few dollars a month, it's one of the best bargains in the entire insurance world. When you look at your renewal, if you have health insurance, check your deductible. Your MedPay limit should, at an absolute minimum, be equal to your health insurance deductible. If you don't have it, add it. It's a no-brainer. Now let's talk about MedPay's bigger, stronger, and more capable sibling, personal injury protection, or PIP. If MedPay is a first aid kit, PIP is a full-blown trauma center. PIP is primarily found in what are called no-fault states. These are states that have passed laws requiring your own auto insurance to be the primary payer for your injuries, regardless of who caused the crash. This was designed to speed up payments and keep smaller injury claims out of the court system. Like MedPay, PIP covers medical expenses. But that's where the similarities end. PIP goes so much further. The single most important benefit of PIP is that it can cover lost wages. Let me repeat that. It covers your lost income. If you're a gig worker, a freelancer, or you just don't have good short-term disability insurance through your job, this is a lifesaver. If an injury from a car accident puts you out of work for 2 months, who's going to pay your rent? Who's going to buy your groceries? Health insurance certainly won't. Bodily injury liability might, but only after you've proven the other driver was 100% at fault, and that could take a year. PIP can start sending you a check within weeks. And it doesn't stop there. PIP can also cover what are called essential services. Imagine you're a stay-at-home parent and you break your arm in a car wreck. You can't take care of your kids, you can't clean the house, you can't cook. PIP can actually reimburse you for the cost of hiring someone to perform those essential tasks while you recover. It covers childcare, house cleaning, even dog walking in some cases. It is designed to keep your entire life from falling apart just because you were injured. This is a level of protection that no other part of your standard auto policy, and certainly not your health insurance, can even begin to offer. So when you get your renewal, if you live in a no-fault state like Florida, New York, Michigan, or about a dozen others, you will be required to carry PIP. The question isn't if you should have it, but how much you should have. Don't just accept the state minimum. The minimums are often pathetically low and haven't been updated in decades. You need to look at your life. What is your monthly income? How much do you need to survive if you can't work for 3 months? Do you have a robust emergency fund? Or would you be in serious trouble after missing one paycheck? You need to select a PIP limit that can realistically replace your income and cover your medical bills. This might mean choosing a $50,000 limit or even higher. Yes, it will cost more. But the cost of not having it when you need it is financial ruin. It's bankruptcy court. It's losing your home. For those of you not in no-fault states, some states do offer PIP as an optional add-on. If you have the choice between MedPay and PIP, you need to seriously consider PIP, especially if your job doesn't provide excellent disability benefits. The ability to protect your income stream is arguably one of the most important functions of insurance. The final question is always, how do all these work together? It can seem complicated, but think of it as a waterfall. When you're injured in an accident, the first bucket to fill is your MedPay or PIP. It pays first, it pays fast, and it pays without argument. Once that money is used up, your personal health insurance would typically kick in, and you'd be responsible for its deductibles and copays. At the same time, you are pursuing a claim against the at-fault driver's bodily injury liability coverage. If and when they pay out, that money can be used to reimburse your own insurance companies and to compensate you for pain and suffering. And if that at-fault driver doesn't have enough insurance to cover your massive bills, that's when your own underinsured motorist bodily injury coverage, which we talked about earlier, rides in to save the day. Each coverage is a different tool for a different job. Liability protects your assets from others. Collision and comp protect the value of your car. Uninsured motorist protects you from irresponsible drivers. And MedPay and PIP protect your body, your health, and your ability to earn a living. You have now systematically built a nearly impenetrable fortress around your financial life. You've shielded your car, your savings, and your health from the chaos of a car accident. But there's one final layer. One last piece of the puzzle that separates basic protection from true, unshakable financial security. It's the one coverage that stands guard over not just your car, but your house, your investments, and your entire future net worth. And it's the one thing that, if you qualify for it, is the single most catastrophic insurance mistake you can possibly make to ignore. I'm talking about a personal umbrella policy. And yes, I know what you're thinking. Umbrella? That sounds like something for millionaires with yachts and vacation homes. That is precisely the misconception that has led countless families just like yours, to financial ruin. An umbrella policy isn't an add-on to your auto insurance. It's a separate policy that sits on top of it, and your homeowner's insurance, acting as a massive secondary shield. Let me paint you a picture. Imagine you're driving home from work. You're stopped at a red light. You glance down at your phone for just 1 second to check a notification. In that 1 second, your foot slips off the brake and you gently roll into the car in front of you. A classic fender bender. Annoying but no big deal, right? That's what your auto insurance is for. But what you don't know is that the driver of that car is a neurosurgeon. The impact, as minor as it was, caused a severe case of whiplash, and a nerve in his hand is now damaged. He can no longer perform surgery. His career, a career that earned him over $1 million a year, is over. He sues you, not for the bumper damage. He sues you for lost future earnings. The lawsuit isn't for $50,000 or even $500,000. The lawsuit is for $5 million. Now let's look at your auto policy. You did the right thing, you listened to our advice from earlier, and you have a solid policy with 250/500 liability limits. That means your insurance company will pay out at most $250,000 for his injuries. They write the check and their obligation is finished. But what about the other $4,750,000? That's on you. Suddenly a court order comes down. Your house? It's being sold. The 401k you've been building for 20 years? It's liquidated. Your kids' college savings accounts? Drained. And even after all of that, you still owe millions. So the court garnishes your wages. For the rest of your working life, a significant chunk of every single paycheck you earn goes directly to that surgeon. Every promotion, every raise isn't for you, it's for him. All because you looked at your phone for 1 second. Your life and your family's financial future was destroyed by a simple fender bender. Now let's rewind that exact same scenario. But this time, when you reviewed your insurance last year, you spent an extra $200 for a $1 million umbrella policy. The accident happens. The lawsuit is filed. Your auto insurance pays out its maximum of $250,000. Then your umbrella policy kicks in. It covers the next $1 million of the judgment. You're still in a terrible situation, but you are not completely wiped out. And if you had a $2 million umbrella, or a $5 million one, you write a check from the insurance company and you walk away. Your house is safe. Your retirement is safe. Your kids' future is safe. That is the power of an umbrella policy. It is financial catastrophe insurance. It's designed for when the unthinkable happens. And here's the secret. It is shockingly inexpensive. A $1 million policy can cost as little as $150 to $300 a year. That's about $20 a month. For $1 million in protection. Why is it so cheap? Because the odds of you ever needing it are low. But if you do need it, it's not a matter of convenience. It's a matter of survival. So who needs it? You might think you don't have enough assets to be a target. Wrong. If you have a positive net worth, you need it. If you own a home, you need it. If you have a retirement account or any investments, you need it. But here is the most important part. Even if you have very few assets, courts can award judgments based on your future earnings. They can garnish your wages for decades. So if you have a decent job and a future ahead of you, you are a target. An umbrella policy protects what you have now and what you have yet to earn. Here's the catch, and it's why this is so critical to check during your auto insurance renewal. To qualify for an umbrella policy, insurance companies require you to have certain minimum liability limits on your underlying policies, your auto and home insurance. Typically, they'll want to see those 250/500/100 limits on your auto policy that we've been talking about, and at least $300,000 in liability on your homeowner's policy. Your renewal is the perfect time to check. Do my current limits make me eligible? If not, you need to increase them. Then you have to actively ask for an umbrella quote. It's almost never offered proactively. You have to be your own advocate. So now let's put this all together. We've journeyed through every line of that confusing document. We've demystified it. Your auto insurance renewal is not a bill. It is a report card for your financial security. It's an opportunity. It's your chance to look at your liability coverage and ask, is this enough to protect me from a life-altering lawsuit? It's your chance to evaluate your collision and comprehensive deductibles and ask, can I comfortably pay this amount tomorrow without causing a financial crisis for my family? It's your chance to check your medical payments or PIP and ask, is this enough to cover my health insurance deductible if I'm injured? It's your chance to scrutinize your uninsured and underinsured motorist coverage, the single most important protection for you and your passengers, and ask, have I matched this to my liability limits to fully protect my own family? It's your chance to decide if the small cost of rental reimbursement and roadside assistance is worth the massive convenience and peace of mind they provide. And finally, it's your chance to look at the foundation you've built with your auto policy and ask the ultimate question. Is it strong enough to support an umbrella policy? Is it time to buy the ultimate protection that shields everything I've worked for, and everything I will ever work for from that 1 in a million bad day? Don't just let your policy auto-renew. Don't just glance at the price and file it away. The 10 or 15 minutes you spend actively reviewing these documents, armed with the knowledge you now have, could be the single most profitable 15 minutes of your entire year. It could be the difference between a minor inconvenience and total financial devastation. So your mission right now is to find your latest auto insurance declarations page. Open the file, pull it out of the drawer and read it, line by line. Ask these questions. Call your agent. Get a competing quote. Take control. You are now more informed than 99% of the drivers on the road. Use that knowledge not just to potentially save a few $100s, but to ensure that what you've built for yourself and your family is properly protected. Because at the end of the day, that's what insurance is really about. It's not about the car. It's about everything else.